Okay, for this video I want to go over the Form 8995 for the QBI deduction. And this is going to be the simplified computation, so we're using the 8995 and not the 8995-A. So specifically I want to go over PTP and REIT income. So qualified PTP REIT dividends and publicly traded partnership income can qualify for the QBI deduction. So in our example here, we're going to look at kind of the interaction between PTP income and then what happens if you also have other qualified business income that doesn't fall within those categories. So I've got the sample return in front of us here, which we'll go into in more detail. I do have a sample Schedule K1, so this is kind of a fake K1 from a PTP entity, and we're going to see how these items get reported on the return and where we get those QBI amounts. And then I do have one sample, or not a sample, one slide here covering some background on this 199A deduction and specifically the interplay between the regular kind of qualified business income components that we typically see, and then what do we do when we have REIT or PTP components. So I'm not going to go into too much detail on QBI itself. I'm going to assume that if you're watching this, you're probably already kind of familiar with the QBI concept, but the QBI computation and the deduction is reported on the 8995 or the 8995A, and this generally grants you up to a 20% deduction on your qualified business income, so it lowers your overall taxable income. Now, the deduction comprises two separate components, and that's what we're going to see on the 8995, is that these are separately stated and separately calculated before they're combined. So the first QBI component is kind of the one that we're more familiar with, right? So this is a 20% deduction of QBI from domestic businesses. So this is flow through partnership income, S Corp, or if you operate a sole proprietorship. Now the QBI component in this bucket here does have some limitations that might apply. So if your taxable income is over certain thresholds, there's certain phase outs that you have to be mindful of. Is it an SSTB, so a specified service trader business, or not? And then do you have other kind of issues with W-2 wage limitations or UBIA of qualified property use in that trader business, right? So that's the one that more often is what we see. Now the second element here is the REIT and PTP component. So REIT dividends and PTP flow-through income can also qualify for this QBI deduction. So these are separately computed from the QBI component up here, but you get the same deduction, right? So the deduction is going to be 20% of the qualified REIT dividend amounts and qualified PTP income. And then the other nice thing is there are no W-2 or UBIA amounts that could apply here to limit the deduction amount. Now, we still have to be mindful of the combined overall 20% taxable income limitation, and we'll look at that when we get to the form as well. But unlike this first one up here, when we talk about income flowing through from these two pieces, the REIT and PTP amounts, we don't have to worry about these W-2 or UBIA kind of issues. So what are the interactions with PTPs specifically and some of these other qualified businesses in this top component here? Well, again, the PTP earnings are separately stated, and you do not net these amounts with other QBI components. Now, what goes into that PTP number? And so when we look at the 8995, what we're referring to is this item here on line 6, right? So if we're going to have an income amount from PTP, what amount is reported here on line 6? So that amount under the regulations includes really two things, right? So the first one is it's the amount of income that's being allocated to you on the K1 that is qualified publicly traded partnership income, right? So it's eligible for this QBI deduction. And then the second piece is you can add any gain that would be recognized by the taxpayer upon the sale of those PTP units. Now that includes gain only if it gives rise to ordinary income, right? So under Section 751. And so what we mean by that is if you're trading your PTP units, when you sell them, you really have kind of two types of gain, right? You could have capital gain, long-term or short-term, but then you could have an ordinary income component under Section 751. And it's that piece of the gain that is potentially includable in that line 6 item for PTP income. So let's look at our fact pattern here, and then we'll go back to the form, and then we'll look at the K1 as well and see kind of how all this is pulling together. So our taxpayer here, John Q. Taxpayer, he operates a consulting business through a single member LLC, and so he reports all that income and expense on his Schedule C, and his business has a net loss for the year, $490. But it is qualified business income, and it is a specified service trader business, so it's still eligible for this deduction. And then what we're also going to see is his income is below those thresholds, so again, he's eligible for this simple computation using the 8995 form. Now, in addition to that, John also purchases a PTP investment for roughly $29,000, and he sells it the same year. So he holds the PTP investment for a couple months, sells it, recognizes some gain on the transaction. So he gets his K1 for the PTP at the end of the year, which shows his allocation of the income and expenses. And that's the piece right here. So he's got his K1 from the PTP entity for just a couple of months that he owned it. And so we can see here it's also being marked final, right, because he sold all of his investment. And he's got some allocable items here, right? So ordinary business income and loss, some interest and dividends. And then we can see here his ending capital account has been zeroed out because, again, he sold all of his investment during the period. All right, so so now on the sale of the PTP, he recognized short-term capital gain of $1,889. And the PTP Schedule K1 shows an allocation of $62 in ordinary losses, and then an allocation of $751 gain from the sale of the partnership for $361. So when John nets these two together, 62 in loss, 361 in ordinary gain on the disposition, he's got qualified PTP income of $299. And then just to highlight here, again, remember, he's not including the capital gain of $1,889, right? Because this is not $751 gain. It's just short-term capital gain on the sale of the partnership interest. So let's look at the K1 again in more detail here. So he's got all of these items here that he's entered on his return. And then if we scroll down to the supplemental information, so that's always in box 20Z, where we have this 199A information on the PTP income. So in this sample K1, we can see down here in 20Z that the ordinary income or loss, that is qualified PTP income, is minus 62. And then there's the $361 ordinary income on the sale of the units, and that's the $751 gain that John had on the sale of the partnership interest. So when we look at John's tax return, if we go to Schedule E here, where he's entered the PTP information, the amount of non-passive loss that was allowed, that's the $62 in ordinary income. And again, that's being treated as non-passive loss allowed because he sold all the PTP units, right? So when you dispose of a PTP investment, all of those losses, if they were suspended under the passive activity rules, they get freed up, right? So there's his $62. On the $47.97, he has recorded that $361 in ordinary gain, right? So he's done everything right there. And then on the $89.95, you can see he's reported that net amount, $299 there. Now, the Schedule C, if we just touch on that really quickly. So he completed his Schedule C as you normally would if you're a sole proprietor. So he's got his income and his expenses. There's his tentative profit or loss. He is treating it, and it does meet the definition of a qualified business. So a consulting business is a qualified business, but it's also an SSTB. So if he did make too much money above that threshold, then he might have some issues with the phase-outs, but in this case he doesn't. Okay, so then if we go back to the $89.95 here, there's his line 1 entry for the $490 in losses. He's got his PTP income there. And so if we look more closely in this area, we can see how these are being separately stated and separately computed initially, right? So the $490 from this qualified business, this QBI component, is not netted against this $299, right? It's separately stated. Because he has an overall net loss, he doesn't have a qualified business income component for this piece for this year. It's carried forward. So the $490 is entered as a carry forward down here on line 16, right? And then we have on line 6 the $290, $299 in PTP income. On line 9, we have multiplied it by 20%. So $60 is that initial PTP component. That's going to be the deduction, right? The $60 deduction. And then, as I stated on the slide, right, even though these two are added up, so on line 10, right, we add lines 5 and 9, so it's totaled here, which is fine, but it's still subject to this overall taxable income limitation of 20% of your taxable income before that QBI deduction. So the income limitation is $14,750, so well above the $60. So he clearly is going to get this $60 deduction, and then again the $490 is carried forward. So if you want to see where does this ultimately end up, well, it is on page 1 of the 1040. So the QBI deduction is reported on line 13 of page 1 of your 1040. So we can see there qualified business income deduction from either the 8995 or 8995A, whichever one you were required to use. Okay, so that covers it for this video. I hope this was helpful. If you have some questions about 199A deductions or PTP sales or anything like that, please feel free to leave me a comment below. Happy to answer any questions I can. And I will put some other links below in the description for some of these other issues, like loss netting or recording the sale of PTP interest. Hopefully those can help as well. All right, so again, that covers it. Thanks so much for watching, and I look forward to seeing you again on the next video. Thank you.